Hello, everyone. Thank you for joining us today. I'm Abilash Jaikumar, co-founder and managing director of TresVista. At TresVista, we are the leading outsourcing firm supporting the financial services industry across a range of activities from business development support, sourcing, screening, investment opportunities, conducting business due diligence, valuation, financial modeling, creating investment memorandums, and supporting clients as well on the data analytics and CFO office services. We have a long history of working with SPACs, which leads us to today's exciting panel related to understanding the continued SPAC surge. We have a great group of panelists today representing a broad spectrum of viewpoints and backgrounds, and I will be very happy to let them introduce themselves. First up, Kevin Charlton, the CEO of NewHold Investment Corporation. Kevin, if you'd like to share a background on yourself.
Sure, thanks, Alysa. I'm Kevin Charlton, CEO of NewHold Investment Corp, trading on NASDAQ under NHIC. We are an industrial technology focused SPAC with $172.5 million in trust. And this is my fourth SPAC. My first three, I was the president and COO of Dan Hennessy's first three SPACs, Hennessy Capital Acquisition Corporation. And for NHIC, our sole book runner was Stifel. So I'll introduce Alysa Craig.
Thank you, Kevin. Alysa Craig, I'm a managing director at Stifel, and I lead our SPAC business. I have been in investment banking for over 20 years and around SPAC product for over a decade through two different generations of SPACs. Prior to Stifel, which I joined in 2014, my background was Credit Suisse, Deutsche Bank, and Rothschild. And it's a pleasure to have this opportunity to present. Thank you.
Wonderful. Don?
Hi, Don Duffy. Thanks for having me today. I co-run ICR. I head up our transactions practice, which includes IPOs, SPACs, and direct listings, and looking forward to the conversation today.
And last but not least, Giovanni Caruso, partner at Loeb Loeb.
Hi, everyone. My name is Giovanni Caruso. I'm a partner at Loeb Loeb. I've been working on SPACs for about 15 years. We do all aspects of SPAC transactions, from IPOs to business combinations and everything in between.
Fantastic. Well, maybe diving right in, if I can start with you, Alysa. Although the concept of a SPAC has been around since the 1990s, what are the key factors behind SPACs gaining so much popularity lately in attracting the big name underwriters and investors? And how have things changed over the last few quarters as SPACs have become a very popular alternative method for raising acquisition capital?
Thank you. You're absolutely right. SPAC has been around as a product for a long time, and it has been through several iterations. And I think not everyone realizes that it actually had already pretty strong momentum going into 2020. 2020, obviously, by all measures, was a record year, and we can talk further about sort of what's been driving that. But we really started this current generation of SPACs. Generation 3 has come into existence in 2010. It included a lot of very important structural improvements over previous generations, which dramatically increased success rates for this generation of SPACs and made the deal and made the structure more deal friendly and also more appealing to high quality investors. So we started seeing a real uptick in issuance in the SPAC market, probably sort of somewhere in late 2016, 2017. A lot of that issuance was driven by higher quality management teams. Particular, a number of prominent private equity funds have raised capital in that format, and that trend continues to persist today. You just continue to see SPACs backed by institutional founders, both private equity and venture capital firms, as well as now public investors and hedge funds. And that really sort of what that did is essentially institutionalize the product, where it in turn attracted higher quality targets that have been performing well in aftermarket post-business combination, and also attracted better quality investors all across the board, both into the upfront IPO as well as into the pipe. That is the most typical way to do these transactions. So going into 2020, momentum was already there, and then essentially 2020 became a record year for a number of reasons. The sort of the key two key drivers behind the surge last year were, first of all, the number of new investors coming into the product that haven't really played in the SPAC product before. And the second one is the M&A transaction volume. So we've seen, you know, an incredible number of the companies that really opted to pursue this as an alternative to a regular way IPO, mostly because of the market uncertainty. You know, SPAC vehicle provides a narrower window through the PIPE process to de-risk the transaction and validate value and essentially give certainty of cash and valuation. And to some degree provide sort of a greater protection in an otherwise volatile market, which a lot of targets found rather attractive. Also, merger proxy disclosure requirements give you ability to market projections, particularly management projections, which also gives you very valuable information, kind of allows you to position the story and hear directly from the management team, which a lot of investors find valuable. So those things really drove M&A volume to very high levels, and as a result, you know, with the amount of issuance last year was, you know, literally more than quadrupled, and the amount of M&A volume with SPACs more than tripled, and that sort of led to kind of the amount of issuance and the M&A transaction volume that we've seen last year. And this trend actually persists into the early 2021 as well. We've seen record issues just in the months of January. We already seen sort of a third of the, almost more than a third of the volume from last year being priced in the form of new SPAC IPOs.
Yeah, and more than all of 2019 just in January of this year. So,
correct.
Yeah, if you look at the charts of SPAC issuance by year and you just take out last year, it seems like 2019 was a record year, and then 2020 just makes everything else irrelevant relatively. You know, Kevin, maybe carrying on that conversation, talking about the record levels amount of being raised for SPAC, what are the advantages versus the traditional IPO process, not just to the target, but to the sponsor as well?
Yeah, so I think taking it, Alysa touched on a couple of these subjects. I think taking it from the target's perspective, I've been surprised. I think a lot of us have been surprised by the degree of enthusiasm in the public markets for earlier stage companies, which were not in my prior SPACs a big portion of our deal pipeline. So if you think about the question from the perspective of a company in need of growth capital, I think there's a lot of significant advantages to the approach. Having done one traditional IPO about 10 years ago, that was about a 14-month process, and along the way, there were a number of times where we weren't sure it was going to work. We weren't sure the deal was going to happen, and in that case, it was a more mature company. It wasn't as big a deal. That uncertain wasn't irrelevant, but it wasn't as big a deal. If you think about it from the perspective of an early stage company, our view, and none of this is black and white, but generally speaking, our view is they're managing 4 different kinds of risks when they think about an IPO or a SPAC. They're managing their proceeds risk, their pricing risk, their timing risk, and their execution risk. So how much are they going to raise? At what price? How long is it going to take? And they're just the binary risk of, is it going to work at all? And you have to balance those. And I think the pitch on a traditional IPO is, we're going to give you a fair degree of funding certainty. So you'll be pretty sure how much you're going to raise. We'll give you a price range. You may fall below it, but a pretty good indication of where you're going to price. Schedule, it's going to take a while, and execution, you know, there may be things that it may work, it may not. With a SPAC, I think to what Alysa was talking about, this element of a PIPE, which for those who aren't familiar with the term, is a private investment in a public entity, but this is the capital you raise before you announce your deal. If you think about it, but in the context of a SPAC with a PIPE, as far as funding certainty, that was always the big knock on SPACs, because you've got this trust and people take cash or equity. You don't really know what you're going to get. With the PIPE, you've got a much greater degree of funding certainty. You have a much greater degree of pricing certainty, because you pretty much, with the PIPE, validate the valuation before you sign the merger agreement. Okay, that's 2. As far as timing, it's a really quite reliable schedule. Like the Gantt chart, it looks similar for everyone. And in all of the ones that I've done or been involved in, from first meeting to flipping the ticker, the phrase we use for when the SPAC ticker becomes the target's ticker on NASDAQ or NYC, flipping the ticker, it should be 4.5, 5 months. I mean, it's a pretty reliable period of time. So you've got a fair degree of timing certainty, and then execution risk. Once you've raised the pipe, you know you're pretty much de-risked. I mean, there are things that could knock you off, but they're pretty much max style things. And you're pretty sure the deal is going to close. And if it's not going to work, if you're not going to get a positive outcome on your pipe process, you'll know that in 4 weeks, 5 weeks, and you can pivot to another funding strategy. So particularly, if you think about that from the perspective of an early stage company, the one thing they want, the one thing they want is cash so they can grow. The second thing they want is certainty, right? They need to know, I'm going to lose all this territory to a competitor if I don't know what my funding strategy is now. So if it's not going to be this, I got to go pivot to something else quickly. So I think particularly for early stage companies, the huge advantage to go public through a SPAC.
Yeah, Kevin, I think I would just add, that's a really good point, particularly as it relates to companies comparing that to the IPO process, right? A young, fast-growing company may have dramatic uncertainty as it relates to the IPO process that, to your point, is de-risked with a SPAC process, because if you are trying to beat a competitor to market and you go through an IPO process that can be as long as 12 months and then it gets delayed or canceled, you can be left at a significant competitive advantage.
Yeah, I agree.
And I think all these elements have eliminated some of the stigma that historically had been associated with SPACs, that only companies that weren't IPO ready would do a SPAC transaction. Today, it's a legitimate IPO alternative, and many IPO ready companies are electing to go with the SPAC because of the benefits that Kevin and Don were talking about.
Yeah, and I want to come back to a couple of the points you mentioned, Kevin, as far as earlier stage companies and how that relates to valuation and the pricing risk. There's a lot of interesting conversations to be had just on that topic. But before we get there, I want to discuss the process a little bit. Giovanni, can you talk to us about the process and timelines for, from the beginning of, a lot of the audience here has been thinking about SPACs. People have been telling them maybe you should raise a SPAC. What is the process and timeline for raising a SPAC? And from a legal and compliance perspective, what trends are you seeing in the SPAC process?
So from the, in terms of the IPO, the process right now is taking 2.5 months from the time you file your registration statement with the SEC until you're able to go public. The putting together a SPAC is really about getting together a team, deciding who your advisors are going to be, your underwriters, your lawyers, your accountants, putting together a registration statement and getting it on file. And the people who are involved in the SPAC market these days are doing that very quickly. You can go from zero to getting something on file within just a few weeks. The process with the SEC has become incredibly streamlined. The SEC no longer looks at SPACs as something negative that they need to really keep an eye on. They look at it as a legitimate part of the market, and they're providing very few comments on your initial registration statements. Likewise, the exchanges are pretty favorably inclined toward SPACs, and you go through a relatively standard process in terms of getting your SPAC listing. So really, if you're starting from ground zero, you can have a public SPAC in 3.5 months, 4 months, which is an incredibly fast timeline. In terms of the timeline for a business combination, well, there are a lot of variables that go into that, including how long it's going to take for you to negotiate your definitive agreement with the target, the amount of time the target needs to produce financial statements, preparing all the relevant disclosures, the PIPE process, which could take 3 or 4 weeks prior to your signing a definitive agreement. And then you have to go through an SEC process, which is you file a merger proxy with the SEC, which includes disclosures about the SPAC, the transaction, the target, financial information, pro formas, and the SEC will review that document. And that could be a 2 to 3 month process with the SEC, which again is not extremely long. And the SEC has been very good about responding to those filings. And from the time you file your proxy with the SEC to the time you close your business combination, you're probably at 3 or 4 months total.
One thing I would add, which I agree with everything Giovanni said, in our experience, the central date you need is when are the financials going to be ready. There are other things that could become the long pole in the tent, but generally speaking, the gating issue and what you kind of center the whole schedule around is when is my, they call it a PCAOB audit, when are my public company ready financials? When is that going to be complete? Everything else kind of is paced before or after that.
Yeah, and Kevin's absolutely right. That is something that is fundamental to the filing. You can't get a filing, put a filing in with the SEC until you have your PCAOB audits. And in my experience, no matter what amount of time you're told those will be ready in, you need to add a couple of weeks to that because there's always a delay. There's always something that pops up that you weren't expecting. And then,
yeah, for those accountants on the phone, the phrase "national office" is not a phrase.
Exactly. It's gone back for technical review.
Government efficiency.
And it's not just that first filing, right? You need to update your financials as you go along. So there could be further delays with the financials depending on the timing of the filing and the timing of the transaction.
Related to the timelines, a practical aspect is finding the company that you want to do the deal with, right? SPACs typically have that 2-year window to find that company.
That's right.
What are you guys seeing as trends as the process of finding the company, and how has that evolved from early days of SPACs to the market now?
Oh, I think all of us would like to take a shot. All right, I'm going to go first.
Go ahead, Kevin. You go.
I think it's massively different. The advent of sell-side advisors is a huge. Yes, it introduces a much higher degree of competition among SPACs for any given deal, but it's a huge dose of efficiency because most of the time you would spend searching for a transaction and a target, but the first question being, is this even interesting to them? You're beating a lot of bushes and asking a lot of, trying to present what a SPAC is and how it works, what's the issue they're trying to address, the capital structure and the corporate strategy, and how might this be a unique solution. You go through this whole proselytizing exercise to explain it, and that's just not necessary anymore. We used to envy traditional private equity auctions because the company's for sale, so you at least know that you're spending your time researching something that's going to be a transaction. And it was always a big part of the sourcing process in the early days was how do you first sift through the ones that are interesting but not really appropriate from the ones who are. At NHIC, our pipeline is almost precisely a deal a day gets added to the pipeline. And it is almost exactly 20% that we get interested in. So call that a deal and a half. And the percentage and then if you look at those, the ones that we've really spent time on as we've narrowed the funnel to eventual targets we're truly interested in, the percent of those categories that have sell-side advisors goes up as you progress to the point where the deals we've spent the greatest amount of time on, almost and possibly all, have had sell-side advisors. So that's a huge evolution in the process. Now, to the other point about building the pipeline and screening the pipeline, one of our arguments is that SPAC experience is very important. And our team has a lot of it. We would argue relative to other teams in the market. And so we're trying to add a lot of discipline to our sourcing process. So we have a framework of about 40 criteria that we apply to, and not the 100%, not the full pipeline, but once we're down to that 20%, the ones where we signed an NDA, we'll apply that framework and just to keep ourselves honest. It's very seductive in a SPAC to get excited about a deal and not really hold yourself accountable to, wait a second, I know I've got criteria for this thing to advance in my pipeline. Now all of a sudden you spend 3 weeks on something you really knew was probably not going to work, and somebody else is taking your backup deal. So you got to be really, really rigorous and disciplined about how you progress through your pipeline. So you know, the goal, our objective was to build that pipeline and sign a letter of intent in 6 months, and I think that's a reasonable goal for SPAC. A lot have been doing it faster, and that's great. But you shouldn't need the 2 years. You shouldn't need the year. You shouldn't need half of it. I mean, you should be able to do it 6-ish months.
Yeah, and I would add, I think, to just build on Kevin's point, maybe at a higher level, if we were on this webinar 3 years ago, we would have spent a lot of time on, Kevin would have talked really about convincing sellers that this was the right approach. The market has completely pivoted in the last 12 plus months there. So that is a sea change in how people think about it, because a lot of people now ask, how should I go public? And I like to think about it, it's almost like The Price is Right. You have 3 or 4 doors. You have an IPO, you have a SPAC, you have a direct listing, and you can sell the business. And I think, you know, this, which touches on the second part to Kevin's point, which is sponsors a few years ago were extremely reluctant to go that route. Kevin touched on this point at the beginning about this certainty of close. Now that you've eliminated that certainty of close, or you've de-risked it, I would tell you, and I'm sure Alysa and Giovanni will back this up, but there's not a sponsor out there that isn't looking through their portfolio today saying, what company in my portfolio fits a SPAC? I mean, these were questions you would never have had before. And, you know, to prove that point, now you've had people like Larry Fink at BlackRock and the head of Ares both sit on their recent earnings calls that they see the SPAC market actually eating into some of the private equity opportunities they historically would have gotten. So I do think when you think about this, the pipeline and the opportunities, and Kevin's pointed out how you think about it, the funnel is broadened considerably because of the way people think about SPACs as an exit or structure.
I think that's exactly right. I think it's looked at as a legitimate alternative to an IPO. So and I've had multiple companies say, well, we're evaluating these 2 options. What should we do? Which way should we go? And it's looked at very much that way. We could do one or we could do the other. So I think that's helped immensely in bringing companies to SPACs.
Yeah, you know, 10 years ago when we were working SPACs, a lot of the use case for the TresVista team supporting SPACs was the building that pipeline, going out and finding companies and building those lists, and that certainly pivoted to screening. And we're getting so many books now how to summarize and you know, efficiently process it. And related to that is the team at the SPAC has evolved as well over this timeline. Like if you look at who the CEO of a SPAC is, maybe Alysa, you know, discuss how the people at the SPAC have changed from who they were to who they are now.
Yeah, so in the early stages of the SPAC issuance, you know, predominant majority of the SPAC founders were groups of individuals. You know, sort of a typical profile was, you know, former, you know, private equity principal, former operator that used to run a company, or you know, was in a kind of a C-level position at the company. SPACs used to be smaller and sort of more sort of industry and geography focused. Over time, as the SPACs got bigger, I think the big sort of game changer really was institutional founders getting into the game and beginning to sort of raise capital as a sidecar vehicle in this format. We also are, started seeing combinations of partnerships of an institutional founder, for example, private equity fund, and an operator. And in some cases, this was driven by, essentially private equity fund wanted to raise capital in this format, and they brought an operator on board because they wanted to pursue a certain sector. In some cases, it was the other way around, where it was a prominent former company executive and private equity fund was backing such individuals. So those obviously became very successful vehicles that resulted in great business combinations. But as of today, there is actually a pretty broad cross-section of the types of founders. You still see groups of individuals with great track record from their past life in, either in the corporate world or on the investment side. But you're also beginning to see a lot of private equity-backed SPACs. Venture capital is the kind of the most recent trend. I think up until recently, you didn't see a lot of venture capital fund-backed SPACs. Now there is a number of them. And it's a very interesting category, especially around life sciences and biotech sector, with a different shareholder base in the structure. And finally, you still have, groups of operators that are looking for targets within a specific sector and really looking to deploy their expertise around the specific sector to create value.
I think you're on mute, Abba.
Oh, sorry.
I was just going to add to a list of the most important categories she mentioned is celebrities are now being added, and they're adding tremendous value to the transaction.
Yeah. Well, actually, that's exactly where I wanted to go next. Is Don is talking about the story of the company's potential and what goes into selling a story. And I think that's one of the common factors between an IPO and a SPAC process. How crucial is the step of selling this narrative to investors, as investors will essentially be writing blank checks?
Yeah, so I think you have two pieces, right? When the first part is the SPAC offering, and I think what Alysa just alluded to and Kevin touched on. When you're doing a SPAC IPO, the audience cares about some different things than when you announce a de-SPAC. The audience on the IPO cares about, I've got deal experience. There are people around the table that have done this before. There's somebody in the group that has actually got public market experience. They care that the folks in front of them have capital at risk. There have been some SPACs where essentially they farmed out the promote, their hired hands. So investors are asking that question. And then this gets back to something you asked earlier. The buyer cares a lot about that you have deal flow and to some extent the sense of urgency, right? You can't have a signed deal, but if I have a sense that you know what you're doing and you likely can find a deal sooner rather than later, I would much rather buy a SPAC that is going to announce a deal within 6 months than month 24. And so while you can't give them that certainty, I think the confidence they have in the team, particularly folks that have had private equity experience and have deal flow, helps. When you think about the de-SPAC announcement, again, very, very different than an IPO. Sometimes I like to call it the upside down IPO, because the first thing Giovanni would tell you when you're going public is to shut up and don't say anything. And when you announce a SPAC deal, you have to talk to everybody. And so when we think about an announcement, a de-SPAC, it's really a 4-part process. It's an announcement. Part 2 is marketing your transaction. Part 3 is close. And part 4 is actually becoming a public company. Just focusing on that first part for a minute. When you announce a transaction, putting out a press release isn't enough, and how you stand out from other transactions is amplifying that message. And so there are things that we do with the SPACs or companies that we're partnering with that includes thinking about the buy-side audience that would care about your transaction. If you're buying a software business, who are all the software businesses that would likely buy that if it was an IPO? Who are the sell-siders that would follow that company? 2, the media plays a big role in this now, and every company really needs to think about a very customized media program because there are not a lot of people around the table that understand that piece of it. And as much as Alysa and the Stifel team help market your transaction, they're not pitching the media. That burden ultimately falls on the target business. And so when we think about that, we think about deal media, CNBC, Wall Street Journal, Reuters, Bloomberg. any business probably has some level of trade media. Who are your friends that cover you already? Because you want them to stay your friends. So if you've been talking to media as a private business for 5 years, you don't want to alienate them. And then the last audience is this enigma that everybody likes to refer to as the Robin Hood effect. And the reality is it's not that. We are on the email recipient end from so many of these transactions, and it's the XYZ family office that manages $1 billion. And why do they care about SPACs? They care about SPACs because they never get IPO allocations. So a SPAC for them is a democratization of the IPO. They can move into the market as quickly as Fidelity or BlackRock and actually buy shares after the deal's announced. So we're seeing very large, what people might refer to generally as retail investors. And so while there's no doubt there's this Robin Hood effect, you know, people forget that people like TD Ameritrade has 15 million accounts on their platform. So there are very, very large constituents of non-institutional holders that you do have to get to, and the only way you can drive awareness to them is with the media. So anyway, it's a long-winded way of saying you have to tell your story. You can't rely on that. Ultimately, after you announce, that continues, and the advisors that you work with have sales forces that go out. But when you announce, in order to stand out, you do have to make sure you're amplifying that release.
One thing I would add to that is, so we're a client of ICR in NHIC. What Don's describing makes it sound like that process starts once you identify your target and sign your letter of intent. We actually bring ICR in very early because their perspective on how to tell the story contributes to our decision about which deal to pursue. I mean, we're looking at a lot of industrial technology deals. I'm an ex-aerospace engineer. I find a lot of them really fascinating. There are some that are easier to tell than others. And working with ICR to understand, okay, how am I going to position this? What's the analyst audience for this? What are going to be some of the harder parts of the story to tell? How are retail investors going to respond? What's the natural peer group? What's the peer group we want to be the peer group, but maybe a little harder to justify? All those things should come into your decision when you're seeing, you know, 1.5 deals a week that you like and a deal a day that's just coming. Like, you need to apply that criteria to which one you decide to pursue.
Yeah, and I think one thing people have mentioned before, but I think it's a good time to emphasize it. One thing that you do get to do with a SPAC transaction is you do get to include projections in your materials, which is not something that you do in a traditional IPO. And as an attorney, I hate the use of projections. They terrify me. But they are absolutely permitted. It is a standard part of the marketing process for SPACs. And you get to put those out even before you file your merger proxy. You may have a presentation that you include with your announcement of a business combination, and it's out there for everyone to see. Although I again, really dislike it, it's a big part of the marketing process.
Yeah, I remember many years ago, you know, over 10 years ago now, we were making one of those presentations for one of our clients. You know, unlike where Don is, you know, really giving an advisory level, we have a lot of people, you know, that are boots on the ground, if you will, making the PowerPoint slides and whatnot. I remember being on those conference calls with lawyers who are like, wait, that's talking about tomorrow. You can't say that at all. But certainly there's a different acceptance of it today versus then.
Absolutely.
Yeah, and you know, Giovanni brings up a really good point though, because that's also a great contrasting point to an IPO, right? Institutional investors in an IPO relied on the sell side analyst who is wall crossed. They get to look at the numbers, they get to talk to the company, and they talk to the institutional investor. When a company is marketing an IPO, they don't give any forward-looking information, or maybe it's not financial, it might be more qualitative than quantitative, but the institutional investor has to rely on the analyst numbers in that deal. What we've heard repeatedly, and you see this based on the PIPE investors and the 13F filings in some of these deals, but the largest institutions tell us, I like the fact that I get forward-looking information. I know what management's thinking about the business. It's very helpful. And so despite a lot of uneasiness sometimes about providing forward-looking information, institutions want it. And so they absolutely want it. It gives them the ability to assess a business without using this intermediary of a financial analyst because they're ultimately getting judged by a number. And I think they'd like to be judged by their own number versus an analyst number, particularly when you're selling a deal.
Yeah. You know, maybe Alysa, you can talk about the positioning of a target in a crowded market. As you know, Kevin was saying earlier, they're seeing a lot of flow. What type of companies were targeted in the past versus the type that are being targeted now?
Yeah, so there's definitely a pretty significant change in sort of in the profile of the target that really occurred over the last 12 months specifically. You know, so and it really, you know, the type of the target that you want to pursue is really, or the investors and SPACs want to pursue is really driven, you know, or SPACs want to pursue is driven by the investor focus and investor interest. So first and foremost, you know, at the core of a SPAC deal is a viable public company. You know, whatever sector you're thinking about, whatever stage of the company you're thinking about, it has to be a viable public company. So that's the first sort of determination that's, you know, is known to be across the board. What we've seen happen in the last 12 months is really shift from focus on more sort of traditional cash flow oriented businesses to so-called growth assets. It's definitely been driven by investor sentiment in those type assets. Interestingly enough, we actually started seeing change in sentiment from investors probably in late 2019, when a lot of investors, even the ones that were traditionally focused on cash flow, started baking in recession into their models, and they started switching focus to growth and as a way to compensate for lack of certainty around the cash flow generation in the foreseeable future. And then of course COVID happened, that only accelerated that trend. So what we've seen in the last 12 months was really predominance of sort of growth equity type of deals that, you know, sort of 18-24 months ago probably would not have been possible. And for one simple reason, because investors were focused on different types of assets. So, you know, to some degree, you know, you have to be in tune with the market and understand what investors are looking for, because they will ultimately drive a decision on whether something should be a public company or not, and, you know, what value and establish the value on that asset. But that's kind of what we are seeing from our side. You know, growth continues to be very strong. You know, even before COVID and the switch in interest, growth, top line growth of the businesses is important for us, for any public company. But you know, obviously what happened last year was quite unprecedented, just in terms of the sheer amount of deals of this type that were being done.
Yeah, you know, related to that, Kevin, you had talked a little bit earlier about, you know, the screening process. Can you maybe get a little deeper into how the target screening and diligence process for a SPAC differs from the traditional diligence process of a private equity firm? And also, as SPAC teams often tend to be leaner than, you know, traditional private equity firms, how practically do you manage this process?
I'm not sure I agree with the second part of the statement that the deal team on a SPAC is materially different in size. I mean, maybe it's 3 or 4 people, I would argue, in a traditional PE deal, but it's ballpark the same, honestly, in a SPAC deal. Look, I think the fundamental difference is not about value, right? What we tell targets is that we are partnered with you on the same side of the table negotiating against the public market. And one of the advantages of sell-side advisors, the good ones anyway, is they know it's about value add, partnership, and well, that's inverse order. Execution, value add, and partnership. It's not about value. And there's a deal that's trading, I will not mention the name, but trading extremely well right now. It's a terrific business, and we bid a number X, and we lost on value, and that deal got renegotiated down to spot on top of the number we bid, then got done, you know, dropped 50% in value, and is trading really well. And that happens, I mean, that was all of 4 or 5 months ago, but that happens less now. So if you think about a PE process, you know, the purpose of diligence is determining how aggressive do I want to be on price. The purpose of SPAC diligence is I am a fiduciary for the public shareholders. Am I, on their behalf, am I learning what I need to know about this company to ensure that I believe it's going to perform well as a public company? It's not about value. And, you know, we have progressed and failed to progress in deals for reasons having nothing to do with value, which is good. The other part on a private equity process is that the bulk of your work is in a competitive environment, right? No one's choosing you until you get to the end through your investment committee, and consequently, I typically run all cash private equity auctions, going to have 3 or 4 people all the way to the finish line, and you're all going to have similar access, and gradually you get a sense of are you ahead or behind? Is this a good use of time anymore? In a SPAC process, you're signing a letter of intent, and I think this is market, it's certainly standard for us, with mutual exclusivity, only a portion of the way through your work. When you've highlighted your key issues, you've gotten comfortable, but your investment at that point is time. And you're saying, I think I'm going to get comfortable with these issues I've identified. And you're able to get significantly greater and faster diligence access because you're not one of 4 people. You can get any meeting with anyone in the company at any time. You can get a very good diligence process done in 2 weeks as a result of that. So it ends up being way more. I find it way more efficient because the bulk of your diligence is at the point where you've won the principal competitive part of it. Now you've got to go win the second competitive part, which is you and the target against the public markets and valuation.
There are obviously a lot of SPACs being raised by private equity firms, and the investment professionals are often overlapping on both those products. Can maybe you or Giovanni speak to how are conflicts managed for the different shareholder bases?
Yeah, it's such a good obvious question. I don't worry about. I would have brought this up a couple years ago and be like, God, that's terrible. How it, they're going to get this. They're going to get sponsor equity in the SPAC, and they get it immediately, and it's not netted in a fund, and they don't have to wait for it. Aren't they going to be incented to send something to the SPAC versus the fund, which might have other friction to it that makes it a less obvious economic benefit for the partners? Okay, good question. The reality is the asset choosing. The corporate strategy of the target and which market is going to provide greatest value. That's the one that's gonna dictate it. There are certainly really attractive companies we have looked at for NHIC that would have higher value in the private markets. It's just not what's in fashion right now in the public markets. But more of it's the other direction, which is because we're targeting a public group, a group that intends or would like to be public. So personally, I think it's important to monitor it. But honestly, I don't see a situation where you have a management team and an owner who's like, I don't care. Just write me a check. I don't care which one. They definitely care. They're the ones who are going to decide, because otherwise you'll end up being the second choice in your PE process and the second choice with your SPAC, because you're like, hey, we'll do whatever you want. That's not what they want to hear.
Yeah, and I think as a practical matter, Kevin is correct that the conflicts of resort sort themselves out because the target's going to select which way it wants to go. As a more technical matter, conflicts really are resolved with the SPAC because it's clear in the SPAC documents, the SPAC prospectus, that the management team owes a fiduciary duty first to any pre-existing relationship. So any company that they were a fiduciary of before joining the SPAC, those have priority over the SPAC. So from a legal standpoint, that's how the conflict is dealt with. But from a practical matter, we rarely see this come up as an issue because, as Kevin said, the target says, I want to be public or I want private equity money. They don't say, just give me whatever it is that you have. They definitely have a preference.
Great. Well, Giovanni, what are the issues that are being faced while negotiating the actual merger agreement? What are the key considerations and risks that investors should keep in mind in the time from the merger agreement to closing?
So from an investor perspective, the thing to look out for is really, and it's not so much from the merger agreement, it's really about the target company. Is this a company that they like, that they think is going to be a valuable asset? If you're looking at the merger agreement, a lot of them are very similar. Most merger agreements today for SPACs don't have things like indemnification, don't have various private company bells and whistles the way they used to. There's going to be hopefully a very good set of reps and warranties, and you're really relying on the management team to do the diligence and make sure that the company is something that should be public. So, part of what you have to look for as an investor is, one, do we trust this management team? Do we think they've gone through a good process? And then the second thing is, do I like the target company? I have all this information about the target. I have these projections. I have a description of the business. Does this make sense on a go-forward basis? So from the investor's perspective, I don't know there's much that they need to focus on from the merger agreement other than this is the right valuation. I trust this management team. Do I like this company?
I would add, I think, Giovanni, the one thing I would point out, and I think this is a nuance that most target businesses don't realize, is that when you look at who the advisor is on the SPAC side and you look at your advisor, you should be careful to make sure you recognize what value they provide in that merger, in the de-SPAC, and potentially in the pipe, because what we've seen on the underwriter side, there's certain underwriters, certainly not Stifel, which is fantastic at this, but a lot of these underwriters, all they do is issue SPACs. And in their underwriting agreement, they're trying to capture all of the deferred gross spread. If you're a target business, technically as you're negotiating your merger agreement, you should think of that money as partially your money and care about how that gets allocated. Because what we've seen in a couple of transactions, I won't name Stifel's competitors, but they have no research capability, they have no significant sales forces, and they actually don't have vertical bankers. So they're essentially bankers that are and ECM people that are just focused on SPAC issuance. And if they're getting paid a lot of that back end deferred gross spread, somebody is going to have to come up with more money to bring the right advisors in. And so, as I often like to say, just some SPAC issuers, sponsors don't realize that, because they may pick somebody because they will say, hey, we're great at getting SPACs public, but they actually don't know how to get a pipe done well. They don't understand the de-SPAC process. And then, you have to bring in experts like Stifel who understand that, who understand how to get a pipe done. More importantly, their team may provide research coverage afterwards, which is a really big issue. Research coverage matters in these transactions, and I think a lot of people aren't even determining between some of these advisors who do it. M&A advisors too are now jumping in on the company side saying, hey, only pay me. And they don't even have a sales force, and they have no analysts. So I think the targets sometimes are a little unsophisticated about that part two of the process and need to understand that.
I think that's true. I'm reminded of the first SPAC that I did. I was accustomed to traditional roadshows, and so we started on a Monday, and Wednesday afternoon that we're standing on 6th Avenue, and the banker from the underwriter, looks at his BlackBerry, he goes, okay, we're done. And he got in the cab and went back to his office. I was sitting there with a hanging bag ready to go to Chicago. I'm like, what do you mean we're done? The IPO is not the hard.
I said earlier I wanted to talk about valuation. Maybe we can discuss that now. And obviously the valuation, the business combination is determined through negotiations with the target company, but how do sponsors approach valuation, especially for early stage company?
You want to do this one, Alysa, or do you want?
Not that anyone has a crystal ball for some of these companies, but.
Yeah, I mean, look, I think it's a challenge in the market today, right? Because we're not, the ones that I did before, they were all EBITDA based and a clear comp group. And well, I should say clear. You had a clear group of comps. Some cases you said, well, I'm 40% this and 60% that, so on a blended basis. But it was this is the average EBITDA multiple, and I need to take a discount to that because I'm not yet public, and you need a little upside. Now, we are. I think it's really exciting, some of the technologies that are getting real attention, whether it's additive manufacturing or battery technology or recycling or sensors or robotics. Some of these things are, a lot of the SaaS models are really exciting. And the public market seems to be saying, look, I am willing to bet that this is going to be successful and pay up for that now. So the question is like, okay, well then how do you value that? And it seems to be that the market is looking at it in one of two ways. We'll give you a revenue multiple versus your 2 or 3 year forward revenue, or we'll take your 5-year EBITDA projection against a peer group and discount that back. And they're kind of looking for those two things to kind of overlap with each other. And in some ways, it feels a bit like a sanity check. Like, hey, if this works, this is going to be a bargain. So that's what I'm betting on. But I don't want to be nuts about it. Like, it has to be some math behind the number I'm paying today. So the market seems to be settling on one of those two approaches. I don't know, Alysa, if you'd agree with that, but.
Yes, I do. And I think it's kind of a new methodology that's emerging that we're sort of seeing, in the making. But I think, sort of that's where the benefit of forward projections, comes into, comes very handy because essentially you can, I think the way a lot of these businesses are valued is as Kevin pointed out, is essentially, by applying this set of multiples to future earnings and revenue and basically discounting them back to today. It's something that I think would be really difficult sell in any other construct. So your sort of the disclosure requirements around these processes give you some flexibility of how to come up with value and what's the appropriate way to look at the at value in the company at this stage.
I think the PIPE process has also been valuable in figuring out exactly what a company needs to, where a company needs to be valued for the public markets. So a lot of times today, a SPAC will, they'll come up with a valuation, then they'll go to the PIPE market, see if they can sell it there. And then if they can't, go back and try to renegotiate something before it becomes public.
Yeah, can we just talk about PIPEs maybe a little bit before I ask for some of your closing thoughts and predictions for the future? Obviously, the PIPEs typically accommodated SPAC merger and are vital closing deals, and they're increasingly being deployed in conjunction with the surge in SPAC mergers. And there's been a huge uptick in the inbound interest by PIPE investors. What should be the relationship between the size of the PIPE and the size of the SPAC, and what are the challenges that are being faced as there are limits on who and how many can invest?
Yeah, I think the PIPE part of the process is becoming so common that it is, the absence of a PIPE would have to be explained. If you didn't have one, people would be concerned that you don't have somebody sophisticated who's done the work to validate the valuation. That's not to say it's impossible. It's not. We had different versions of PIPEs in the earlier SPACs I was involved in.
So it's a bit like the equivalent of a pre-IPO round.
Yeah, effectively. In a pre-IPO round, you'd want high-quality VCs, right? Because you'd say, well, I want the smart people to be the ones who said this is a really interesting technology or big TAM. And I think that is the equivalent here. We actually have 3 anchor investors in our IPO. So and I'm going to actually make a plug for them because it's UBS O'Connor, Magnetar, and Mint Tower out of Amsterdam. And they have been really good partners as we have screened our deals. They'll do multiple calls a week as we talk about potential targets because it's usually a sector, as we can't talk names and things, but they'll give us a real live sense of what the PIPE market is thinking. But the PIPE process, for those who've been through a bond roadshow or IPO roadshow, I don't know, it feels pretty similar. You're doing 30 or 40 meetings probably. Your hit rate will be, 50% is good. If you're doing better than that, that's great. And you're trying to get a book that's meaningfully oversubscribed. Not perhaps, some of them are wildly oversubscribed, but not as much as a traditional IPO. And I would say, as far as your point on, on process, or size, excuse me, that, I mean, we have generally, you want to be within spitting distance of the size of the SPAC. And I think the reason for that, I would argue the reason for that is, so we would typically, with 172.5 in trust, approximately, we are most competitive when the size of the pipe is 200. And the reason for that is that we would strongly advise against, when you sign the merger agreement, you don't want to be dependent on what happens with the trust, because something could happen, everyone decides they want cash, everyone redeems, whatever, and all of a sudden your deal fell apart because you have a cash minimum on your trust that you can't accommodate because people redeem. So you want to structure the deal so that no matter what happens, you've raised enough in the pipe that you can close. And if you think about it, that actually encourages good trust performance because the buyers of your SPAC shares know the deal is going to close. So, that, and so now if you take it from the seller's perspective, well, they, if they have a really big pipe and a small SPAC, why don't they just go get a bigger SPAC? And if they have a small pipe and a big SPAC, well, are they really guaranteed the cash they need? So we're seeing ballpark about the same size.
So closing thoughts, if I can ask each of you to just give a short thought of what you expect to see in the SPAC market for 2021, hopefully as the world comes back to normal. What do you see as far as fundraising, deals closing, valuations, regulatory changes as more attention is brought to this part of the market? Kevin, you want to go first?
Sure. Yeah. I mean, the question we get asked all the time is it a bubble? And we would strongly argue it's not a bubble on the target side. The quality of companies that we're seeing, the most common concern we have as a SPAC team is that the company's not quite ready. It's not that it won't be, it's just that and usually it's a year or two. And so certainly if I take that combined with what looks like very deep interest among public market investors to provide capital that's less expensive than late stage VC or private equity or growth equity, that part of it seems to be here to stay. I think the big question is, okay, on the supply side, there's an amazing number of SPACs, and not to criticize my SPAC brethren, a lot of them haven't done it before. So I'll be pretty curious to see how that plays out. And we would argue that there's going to be a flight to quality. We expect to be part of that flight. But we certainly would argue that the product is here to stay. I think the bigger question, frankly, is what happens to the traditional IPO product, because we would argue it's not competitive with SPAC.
Giovanni?
Yeah, so I think what's going to be interesting is, given the volume of IPOs that have been completed, how are all of these SPACs going to find targets, and are all of them going to find good targets? I think they are out there. I think the question is going to be how long it's going to take for deals to get done, how long it's going to take for targets to be located. And to Kevin's point, I think some of the experience that his team has, as opposed to others, will benefit him as opposed to those that don't have experience.
Don?
Yeah, I agree with what both of them said. So instead of repeating it, I'd say two other kind of sub-trends. Number one, I think people who are going through the de-SPAC are going to realize getting a quorum at a shareholder meeting isn't as easy as it used to be. And they're going to have to use tactics like get out the vote. You've saw 2 deals last week that couldn't get a quorum. And fortunately, we've never had that problem in one of our transactions because we know this. But if you don't have experts around the table, what we call traditional proxy solicitation doesn't work when 50% of your shareholders are not it can't be identified by name. And then I think the second thing is that you've already seen this uptick, but because of the volatility in some of these names, I touched earlier on how important research is, but I think you're going to see an increased emphasis because there have been 7 short reports on SPAC deals. And so as people potentially choose bad targets, you're going to see some folks increasingly issue short reports on these poorly operated or targets that with a simple Google search I won't name one, but one of them had a CEO who was a felon. These are, they're not doing diligence like Kevin does, but you have to recognize that somebody's going to figure this out pretty quickly, and they're gonna, the minute your deal closes, the first report isn't going to be the report you want. And so I think those two are sub trends that people have to pay attention to.
Alysa, the final word?
Yeah, so again, not to be repetitive, agree with everything else that was said. I think one of the key drivers of the health in the SPAC market is really the deal performance. We need to, the deals that have already been done need to continue to perform. And if you compare it to a regular way IPO, you always track aftermarket performance, and there are always sort of winners and losers over time, but sort of on balance, you need to see more business combinations succeed over time than those that will create negative examples. That used to be issue in the past. We have been fortunate to see very strong performance from recent transactions that were done. But obviously the verdict is still, jury is still out. We have yet to see sort of how this will play out, and we have more and more questions coming to us. Well, how is this going to persist over time? So in that sense, I kind of going back to Kevin's, one of the first points that Kevin made was quality of targets coming to market is critical, and making sure that they perform over time, that you don't just get the deal across the finish line. It will affect the health of PIPE market, which is critical for survival of the SPAC product, and it will affect the new issuance market in turn. All of these things are interrelated. So we will hoping to see great deals being done and those deals performing over time.
Well, fantastic. Well, I want to thank all of you for participating today. It was a wonderful conversation with great insights, and I'd like to thank our audience as well. If you have any questions, feel free to email us reach us at TresVista.com, and target, if you'd like to be connected with any of the panels as well, let us know, and we're happy to oblige. And certainly everyone on this panel has deep experience in SPACs, especially with Don, Giovanni, Alysa, and as Kevin's works with all of us, it can be a very turnkey team to get you going on the SPAC world. Thank you, everyone. Have a wonderful day and stay safe and warm wherever you are.
Thanks all.
Bye-bye.
Bye-bye.
Thank you.